U.S. Treasuries have erased this year's losses as signs of cooling inflation give way to more bets on future Fed rate cuts. But Treasury investors are growing increasingly concerned around the ability for the Fed to deliver that soft landing. Yahoo Finance's Jared Blikre has those details for us. Hey, Jared.
Hi, Rochelle. We're talking about the U.S. Bloomberg Treasury Index here. That has climbed back to 0% on the year, but not every investor who's investing in bonds has that exact allocation. One of the most common methods is TLT by iShares. You can see that 20-plus year bond ETF in cyan here, still down 9%. And I want to compare it here to the Invesco QQQ index that tracks the NASDAQ 100. That is up a whopping 45% here, threatening to take out these highs from earlier. And the thing about bonds is, even last year, they were not any help to stocks during that tremendous downturn. And in fact, this would make the third year in a row, if we end up in the red, that bonds have lost money. And that's something that has only happened a couple other times in United States history. So very rare indeed to see the diversification that you usually get from bonds just simply disappear. But maybe, just maybe, it's coming back right now. So this is a year to date. Just want to show you what it looks like over the last 3 years. And you can really see how TLT here in the cyan has just trended down that entire time and just barely off of the lows here. Meanwhile, the Qs, the NASDAQ 100, threatening to take out these ultimate highs, these record highs from 2021. I want to take a look at the yield curve because a lot of the outperformance we've had over the last month has been because yields have dropped considerably. Here's where we were 1 month ago. This is the U.S. yield curve, October 19th. Here's where we are in cyan today. That is a difference of about 55 basis points in the longer end of the curve. And that means a lot because if yields had accelerated beyond 5%, that would have been a huge repricing, caused a lot of repricing, and it would have been a huge drag on risk markets. Want to show you something else, Rochelle, because you were looking at the expectations for rate cuts. This is a month ago comparison to where we are today. The cyan line is October. We were expecting fewer rate cuts, closer to, let's say, 3 and change here, as we are today, 4 and change. So more rate cuts, does that mean that investors are more optimistic? Well, not necessarily. Rate cuts are not always a good thing if they are implemented in reaction to overcoming a recession. So if they're just gradual rate cuts, the way we were expecting a month ago, that's all well and good. But if the Fed sees a recession on the horizon, they're going to start cutting 100 basis points at a time very quickly. And then we're going to be talking about 8 or 12 rate cuts. So clearly that hasn't happened just yet. But if investors feel the need to price in more rate cuts, that just steadily approaches that hard landing scenario. So not there yet, but just incrementally moving in that direction. Bottom line, though, Rochelle, for investors, really happy to see at least one index for treasuries climbing back into the green this year and ending that 3-year drought that we've had.
Indeed, and keeping an eye on the potential for rate cuts. I guess be careful what you wish for, as you mentioned there, depending on why the Fed is cutting those rates. Appreciate you, as always, our very own Jared Blikre.